Hello, this is Charting Man Dan of TheChartGuys, where we teach the little guy and girl how to utilize charts to manage their own trades and investments. What do I mean by the little guy and girl? Well, we just had two directives signed halting the implementation of a rule that requires financial advisors to act in the best interests of their client. Let that sink in a little bit. The big wigs on Wall Street can play with your retirement and hard-earned money without your best interests at heart. We currently have hundreds of members taking charge of their financial future, and we would love for you to come check out a free week with no credit card required to see if our services would be beneficial on your path to financial independence as well. What we offer, we have a separate course of over 5 hours in length on when to enter and exit positions. And in terms of what we do daily, we have nightly videos, key levels updated each morning before the bell, 2.5 hours of live daily webcam coverage in the morning and in the afternoon, and over 7 hours of educational videos. All of these links can be found in the description of this video. Come check us out. Thanks for watching. Let's get on to the technical analysis. Hey everyone, looking at SPY on the daily weekly time frame along with IWM and QQQ. So we got consolidation, certainly no surprise after the big time move we saw yesterday. What stands out to me, the close at the low of the day. We have not really seen that in 2017. That indicates momentum heading to the downside. We are now filling the gap. We have a gap fill target of 236.95. What also stands out, volume. Bull volume, easily well over bear volume. No red flags for the bulls right now. This is normal, healthy consolidation. If we start to see increasing bear volume, that will be a red flag for the bulls. If after we fill the gap, if we break the low of the previous Friday, 235.41, that would be a red flag. But as of right now, no red flags. We just know that we're looking to the downside. So if you're in long-term bullish positions and utilizing the weekly chart for your guidance, there's no red flags here in most of these individual names. If you are a short-term bull, or if you're looking to be a day trader and looking for short-term gains, you're looking to the downside because that is what this candlestick is telling us with that close down near the low of the day. So we're looking for this gap to fill a little bit. On the weekly time frame, what we're also going to be watching is how we close this week. Look at the past 5 weeks. Look at the absence of an upper wick showing profit taking. That is momentum heading to the upside into the coming week. And if we see even just the slightest red week, or even if we close break even tomorrow, we're going to see an upper wick here showing profit taking with the potential to form a bearish reversal inverted hammer. So we need to be very cautious of that. Again, normal healthy consolidation. For the long-term bulls, we could pull all the way back down to 228 and still be just fine. As long as we hold this low of 222.73, this weekly higher low pattern remains intact. So it's all about perspective. It's all about the time frame of your trades, and that determines what kind of emphasis you put into what kind of time frame. So IWM, another bearish day. And when I say another bearish day, I just mean it's a very similar candlestick to what we had back on Tuesday. And of course, we had the higher open, but that was in response to the speech. So the close near the low of the day, this momentum is favoring the bears to the downside. Watching this middle Bollinger Band support, likely to be tested tomorrow. It has held the past 2 tests, and tomorrow it's going to be in the mid 138 range. So that's going to be a key level going forward. If we can hold that, the bulls remain in control. If we lose it, I'm looking at 137.76 and 137.30 as 2 key support levels that the bulls want to hold going forward. The weekly time frame for IWM, we're seeing that same upper wick. And if we lose exponential support, which has held for the past few months, that would be a bearish indication as well. But as of right now, we are seeing a bearish reversal candlestick and looking for confirmation next week. Same thing as the S&P 500. QQQ, same kind of weekday. There's a gap to fill at 130.45. The low that the bulls want to hold here to remain their strongest is down at 129.38. So that would be the level to keep the higher low pattern alive. On the verge of a bearish MACD cross, but no red flags at this point unless we break the higher low pattern. And finally, the weekly time frame, same thing. We had a bearish reversal candlestick last week that we are currently negating, but we have an upper wick forming this week, and we could be forming an inverse hammer and a bearish reversal candlestick here as well. So we do need to be cautious as bulls. Normal healthy consolidation certainly should not be a surprise to anybody, and the question is going to be, what's the volume look like? Are we maintaining higher lows on the daily time frame? As to answering the question on how much downside can we anticipate. So the momentum is heading in the bears' favor heading into the end of this week, and we'll see if these weekly candlesticks tomorrow form these upper wicks and bearish reversal candlesticks. I appreciate you watching. See you soon.